This is the highest volatility I have experienced. Substitute the word risk for volatility. You see today the market made a little bit above 800 or 3,800, then it broke all the way down until we got a short covering rally that took over in J period. The J period short covering rally was very strung out, which is indicative of what happens with short covering. Now, the last thing on this profile I want to call your attention to, you see the settle, and then the last is several handles below the settle. So the settle took place within the profile, and the last was substantially below the settle. Usually when I see that formation, that is an indication of a market that had a weak close. Remember, if the market got too short, you get a short covering rally. The short covering rally can actually set the market up for further break. The reason you get short covering rallies very often is because inventory gets too short and you have to rally before you can break further. The relationship of the last to the settle suggests that this was a weak close. There's been some discussion about VIX, and what a lot of folks don't understand is that the VIX is an imperfect measurement that is based upon the purchase of puts. That is one-sided. The best way to currently judge volatility is through your own eyes. A lot of people say, well, how can it be that the VIX is going down, but yet the volatility is as high as it is? And that's because there's a flaw in the construction of the VIX. There's not an awful lot of large put buying going on right now. The larger firms are pretty well hedged to begin with. When they buy puts or they put on hedges, they have to sell futures in order to hedge the position that the dealers help them establish. But they're not putting on new positions right now. I mean, there's always something, but the majority of positions are on, and the VIX is imperfect. The next topic I want to talk about is the poor messaging by the FOMC on Wednesday. The written message appeared to hold out a softer touch. And as we saw, the market rallied a couple hundred handles. Then the chairman came on and said it was simply premature to begin to think about relief. And of course, that caused the market to break very sharply. What you're looking at in front of you is a 2-week bar chart. The low of the last 2 weeks is at 37.04. The mechanical nature of that low being so close to 3,700 suggests to me that it is a weak low with good odds that it will be taken out sometime, in the probably near future. The coming week is probably going to be as confusing as this week. We start off and we have elections on Tuesday. So late Tuesday night, Wednesday, we start to get, some results. We have the all-important CPI on Thursday, which gives the FOMC and the rest of the world another look at inflation and if there's progress or not. And of course, then while the NYSE is open on Friday, it is a bank holiday. I would suggest that it's going to be a very difficult week for traders. I'm not sure we're going to know any more than we do at the end of this week. The most important thing to remember, particularly as a short-term trader, you have no obligation to trade. Too many times, traders get caught up in the emotion of these markets and end up getting whipsawed. If you're going to trade, pick your spots. For example, there were two clear spots today. The market showed an excess high at the 3,800, and you got a small excess on the low late this afternoon. Those were the two obvious spots. Everything else was an awful lot of whipsaw. I wish you well, and unfortunately, I think it's going to be another very difficult week. Thank you.